Hello and welcome to TradeFlow Television,
bringing you valuable analysis and actionable intelligence
through the global commodity markets.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
China's Shanghai Futures Exchange will prepare for the listing of ferrochrome futures, advanced products like cold-rolled coils, medium plates and steel options, and speed a drive for foreign investors to trade steel futures, an exchange official said. China's internationalization of commodities futures contracts would allow foreign investors to trade in them. At present, foreign companies have limited access to its commodities markets. The measures will fend off systemic financial risks and safeguard stable operations, Exchange Chairman Zhang Yan told the online China Steel Development Forum on Friday. The opening up of the steel futures market would enhance its pricing power in the global market, he added.
Moving on to the top news in the energy sector.
U.S. energy firms cut the number of oil and natural gas rigs to a record low for a 12th straight week, although they added an oil rig for the first time since March as a recovery in crude prices tempts some producers back to the well pad. The U.S. oil and gas rig count, an early indicator of future output, fell by 2 to an all-time low of 251 in the week to July 24, according to data on Friday from energy services firm Baker Hughes Co. going back to 1940. That was 695 rigs, or 73%, below this time last year. U.S. oil rigs rose to 181, while gas rigs fell 3 to 68, their lowest on record according to Baker Hughes data going back to 1987. More than half of the total U.S. oil rigs are in the Permian Basin in West Texas and eastern New Mexico, where active units increased by 2 this week to 126, their first weekly increase since mid-March.
India's oil imports fell in June, hitting their lowest since October 2011, as refiners curbed purchases due to maintenance turnarounds and weaker fuel demand, data from industry sources showed. India, the world's third biggest oil consumer and importer, received 3.2 million barrels per day (BPD) oil in June, a decline of 0.4% from May and about 28.5% from a year ago, the data showed. Last month, India did not import oil from Venezuela for the first time since June 2009, the data also showed. Refiners including Indian Oil Crop, the country's top refiner, Reliance Industries, operator of the world's biggest refining complex, and Bharat Petroleum Corp plan to shut units for maintenance. Indian fuel consumption, a proxy for oil demand, typically tapers during the 4-month monsoon season from June as rains hit construction and transportation.
We will now look at the top news in the agricultural sector.
Mills in Brazil's Center-South produced 3.02 million tons of sugar in the first half of July, 55% more than in the year-ago period and just shy of the 15-day period record, as plants continue to heavily favor the sweetener at the expense of ethanol. According to a Friday's report by sugar industry group Unica, ethanol production fell 2.3% in the period to 2.12 billion liters, while ethanol sales were 14% below as the fuel market remains depressed by coronavirus-linked measures. Cane crush hit 46.54 million tons in the first half of July, 13% more than a year ago. Sugar production was near an all-time high for a 15-day period reached in 2017 of 3.1 million tons, as mills allocated around 48% of cane to the production of the sweetener, a much higher amount than the 36% last year when ethanol was gaining market share in Brazil. Market estimates gathered by S&P Global Platts had indicated sugar output at 3.08 million tons and total crush at 45.8 million tons. The market was expecting an even smaller ethanol production at 2.04 billion liters.
Next we have agricultural price moves.
Chicago soybeans softened on Friday as optimism over Chinese buying in the United States was tempered by political tensions between the two economic heavyweights. Corn ended lower on strong crop conditions, while wheat rose on hopes of new U.S. export sales with the dollar remaining low. The Chicago Board of Trade's most active soybean contract ended down 0.75 cents at $8.99 minus 1/4 a bushel. CBOT corn ended 1/2 cent lower at $3.35 a bushel, and wheat gained 10 cents to $5.39 minus 1/2 a bushel. For the week, the most active CBOT corn fell 1.4%, the third week of losses for the grain, while CBOT soybeans gained 0.5% and CBOT wheat added 0.9%, its fourth consecutive week of positive movement.
We will now take a look at energy price moves.
Oil prices rose on Friday, lifted by some supportive economic data, but tensions between the United States and China limited gains. Brent crude futures rose 3 cents to settle at $43.34 a barrel. U.S. West Texas Intermediate crude futures rose 22 cents to settle at $41.29 a barrel. For the week, Brent rose 0.5%, while U.S. crude rose 1.7%.
Moving on to metal price moves.
A deepening U.S.-China confrontation put copper on track for its first weekly loss since mid-May, but analysts expect recovering demand and low stocks to keep prices high. Benchmark copper on the London Metal Exchange was 2% down at $6,413 a ton at 16:20 GMT on Friday, for a weekly decline of about 0.5%. However, prices remain close to a two-year high of $6,633 hit on July 13. Copper has rebounded from $4,371 in March as China, the biggest consumer, controlled its coronavirus outbreak, reopened industry and launched infrastructure projects. LME aluminium was unchanged at $1,701 a ton. Zinc fell 1.3% to $2,210.50. Nickel slipped 1.2% to $13,640. Lead lost 0.9% to $1,809.50.
Next, we have the most recent news on the financial market.
The safe haven yen rose on Friday to its highest in more than 4 months, while the dollar slumped to near a 2-year low, as risk appetite waned due to a host of concerns, including a continued rise in coronavirus cases, a delay in the U.S. stimulus package bill, and simmering U.S.-China tensions. The dollar posted its biggest weekly decline in almost 4 months against a basket of currencies, and also saw its largest weekly percentage loss against a surging euro since late March. In afternoon trading, the dollar fell 0.8% against the yen to 105 yen and 99 sen, having dropped to 105 yen and 68 sen, the lowest since mid-March. Against a basket of currencies, the dollar slid 0.4% to 94.42. Earlier in the session, it plunged to 94.358, a fresh 22-month low. Analysts said U.S.-China tensions also undermined the dollar. The euro, meanwhile, hit a fresh 22-month high against the dollar and was last up 0.4% at $1.16415.
Finally, we have updates on key economic events that are happening this coming week.
On Tuesday, July 28, the Spanish unemployment rate and U.S. consumer confidence will be released. On Wednesday, July 29, the Australia CPI QOQ and U.S. pending home sales will be announced. On Thursday, July 30, German preliminary GDP quarter-on-quarter, U.S. advanced GDP for the second quarter annualized, and U.S. initial claims for unemployment will be released. Lastly, on Friday, July 31, China manufacturing PMI, Canada GDP, U.S. Core PCE Price Index and Chicago Purchasing Managers Index will be announced.
That is all for today's news on the commodity market. Stay tuned to TradeFlow TV as we continue to provide you with more updates. You can also follow us on Twitter at TradeFlow TV1, which allows you to watch our program on your mobile device or desktop.